What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. I wanted to share an awesome interview that I just did with Jeff Kamke from Wealth Energetics. And he was kind enough to have me on his podcast and YouTube channel. We just had an amazing discussion talking about infinite banking and dividend paying whole life insurance, IUL, the difference between the two, and why we chose the path of going with dividend paying whole life insurance instead of things like IUL, and just the overall philosophy about why we set these policies up and all the incredible benefits that we get from them. So it is a really, really good conversation to listen to if you're interested in infinite banking. If you have questions about IUL and dividend paying whole life insurance, what's the difference? Which one do I go with? This is absolutely the video that you want to watch. All right. So make sure you stick to the end if you can. I know it's a little bit longer, but I promise you it's worth it. There's some really good stuff in here. And of course, if you have any questions, drop them down in the comment section below. Also, I'd love to hear your thoughts, any feedback. It's always fun reading the comment section with this stuff. So feel free to share your thoughts down in the comments. Enjoy the interview, and I will see you soon.
All right. What's up, guys? Jeff Kamke here with Wealth Energetics. I'm excited about today's podcast interview with Matt Toyshel. He's with Millennial Wealth Creator, and him and I have gotten to know each other through Life 180, and I love his heart. I love what he has to bring to the table around just a level-headedness around money and wealth and what to do to create predictable, stable wealth for people. So I'm excited to talk today, Matt. Thanks for joining me, and let's have a good time, man.
Yeah, man. Looking forward to it. Thanks for having me. I'm excited. It's been a pleasure getting to know you and listening to your journey. It's awesome to be on the front lines together with this. So I'm having a lot of fun with it.
Absolutely. Yeah. So I think it's a good spot to start is, let's talk about our journeys into all this. I know you've got a background in marketing and you've done some cool stuff there. And, you've kind of pivoted a little bit into things you're passionate about. I know you've got a really unique perspective on whole life insurance and the way that we utilize it. So let's start off there. Let's learn a little bit more about you, man.
Yeah, man. So I never planned on getting into this business. Just kind of fell into my lap. I felt this responsibility, obligation to share my journey and cut through some of the really conflicting information that I ran into when I first started going down this rabbit hole of infinite banking and IULs and whole life insurance. Like what's the best thing to do for me, right? So I started an online marketing agency is a few years ago. I started a YouTube channel for it, kind of doing the same thing that I'm doing with Millennial Wealth Creator now, where I was just sharing my journey. I was just sharing the results that I was getting. And eventually it started to kind of take off, and it eventually turned into a pretty successful online business, at least for a one-man shop. And because I had made so many financial mistakes before and during that, I got really good at saving money, became a lot more risk adverse. Like, when you've been super broke, you never want to go back, right? So you tend to hoard a little bit of the money that you make. So I was able to save a good portion of my income. My lifestyle didn't really, or my expenses didn't really increase with my income. Like I was really careful with that. And so I started, just saving up money. And when you reach that point where you're like, okay, I want to start exploring some different investment opportunities. I basically want to put my money to work, right? That's the next, that's the level that you hit. And I hit that. And I remembered hearing about this concept of infinite banking and IULs with upside potential, downside protection in the market. And it had always been something that I wanted to do. It just made sense to me. So I reached the point where I was like, okay, now that I'm in a stronger financial position, let me get back into this. Let me start doing my research and see if I could put my money into one of these things. And that's when I started going down the rabbit hole of infinite banking and how these products work. And, I listened to a lot of Doug Andrews stuff, and I was pretty much sold on the concept of IUL. And then lo and behold, one of Chris Kirkpatrick's videos shows up right next to Doug Andrew. He makes a lot of videos going against Doug Andrew. And it was talking about the lawsuit that he was in or something like that. And I was like, oh, this is interesting. And, that wasn't a deal breaker for me. I mean, people get sued for dumb stuff all the time. Like, just because somebody says that doesn't mean it's bad. Just got to look into it. But the problem was, as I looked into it more, not just Doug Andrew, but the concept of IUL, like I binge watched so many of Chris's videos about the dangers of IUL and how they actually work. And he was a big proponent of dividend paying whole life insurance. That's when I reached this conundrum. I was like, okay, now I'm like, stuck in the middle of this. I have no idea what to do. But it was so fascinating to me. And I just dove into it. And the more I dove into it, the more I learned about this stuff, the more I realized, like, man, thank God I did not put my money into an IUL. It's definitely not right for me. Maybe it's right for some people as long as you know what you're actually putting your money into, which when you do, you tend to run the other way, just like I did. But maybe it's right for somebody. The problem is, I don't think a lot of people know what they're buying with these things. Number one, and I don't think a lot of people know what they're these agents like they know what they're selling either. And so as I learned more about the whole life insurance concept, the infinite banking concept with whole life, is like, this is a no brainer for me. Like once I learned how it worked, all the benefits that we get, sign me up. I'm working on my second. I actually just got approved for my second policy today.
Nice.
And so it just became a no brainer to me. So what put me down this journey with like starting Millennial Wealth Creator was, one, I want to share this awesome strategy of building wealth. This awesome, awesome strategy as known as infinite banking, this amazing tool known as dividend paying whole life insurance. It's such a powerful strategy and asset. Like I just feel compelled to share it with people, you know? So that was number one. But then number two, I was really concerned about some of the information that is out there around IUL. I mean, to the point where I almost dumped a pretty decent amount of money into an IUL, and I would have taken a, you know, I would not be happy with it. We'll just put it that way. And so I just felt this moral obligation, I guess, to share my journey, share what I've learned about this stuff, and just share the facts and let people make their own decisions. Like, you can't just say, hey, this thing gets upside potential, downside protection, all this tax-free retirement income, this ridiculous illustration that they show you, and you can never lose money in IUL. I can't tell you how many agents I've heard say that. I was like, I'm sorry, I can't. Not on my watch, man. I'm sorry. I've got to call some of this stuff out. And that's kind of where I'm at now. You know, I really resonated with Chris's message, so it was a no-brainer to join his agency. And now I'm just on a mission to, you know, share the facts, share these awesome things, these awesome, you know, dangerous things like IUL. That way people can make the right decision for themselves. Because for me, dividend paying whole life insurance was absolutely the right decision for me. But had I not done my research, had I not had access to the information, had I not learned how these things actually work, I would have made a completely different decision that would not have been good for me. And that's what kind of keeps me up at night. And it's like, I got to do my small part in that, to just expose what's happening. Here's how these things work. Then you make the decision. So.
I love it. Yeah, that's a big key is doing that background research and making sure what you're getting into. I mean, as Chris always talks about, Chris Kirkpatrick, is making sure your money's in alignment with your values and beliefs. And I think underneath the debate between IUL and whole life, there's like foundational differences in what people are going after. I mean, with whole life, and even whole life can be written in the traditional way where it's just a full base policy. It's all going towards the death benefit. There's not the cash value. You're not getting a lot of those extra benefits out of it. And in that respect, Dave Ramsey's and those types can be right. Like whole life isn't that great of an instrument, but when you can do the paid up additions right, or you can add extra cash value to it, it starts to blossom into a totally different animal. And then is it going to be the investment replacement? No, we're not doing it for that reason. We're doing it as a savings alternative. And that's probably one of the big things that I see a lot on the IBC side. These guys on TikTok that are promoting, you know, the IBC, the infinite banking message, is that there's always positive arbitrage. You can be making money like that. And there's a lot of half truths on the IBC side. And it's really tricky sometimes to navigate through all that. But if you as an agent don't take the time to look at both ends of the spectrum and do some cross analysis and figure out, okay, this camp's saying this camp's saying this, what's the truth? Let's dive deep. Let's talk to carriers. Let's talk to people that have been in the industry for a long time.
Right.
And you can start to figure out like, okay, I can cross this off. This camp's not accurate about this. This camp's not accurate about this. And eventually there'll be a truth that comes out of all that. And I think a lot of us here that are with Chris Kirkpatrick now with Life 180, most of us have done that. We've gone through that journey of figuring out like, okay, I'm just not like a blind follower of the infinite banking message. I love Caleb Williams with Better Wealth because he talks about a much more balanced, you know, approach to all this and where the pros are, where the cons are to all the different financial instruments. And that's what I like about what you talk about too, Matt, is like, let's figure out what's right for you. Let's cut through the noise. Let's cut through the marketing and get to what is the best product for you. And for some people, like you say, if they understand an IUL, and they understand all the moving levers that can take place in that, and they still feel 100% aligned with that after they have a thorough understanding of what that instrument can do for them,
Yep.
then that is the right thing for them.
Correct.
But like you said, so many agents. I was on TikTok for a few minutes last night and I caught a live of this expert in the IUL space that he renames it a different thing. But he's talking about how if you had $2 million, you could direct message him right then and there. And within 30 days, you could start pulling six-figure income and be retired in 30 days. That's what he said verbatim out of his
Oh my
mouth,
God, man.
out of an
That's
IUL.
crazy.
It's like I about dropped the phone. I'm like, what are you doing? Like, you can't like guarantee somebody that they're going to be
Yeah.
retired at a six-figure income level. There's
I
so
don't
many
know how that's
moving
legal.
pieces. And, it's just pervasive in the industry. And I know, you're passionate about it. Chris Kirkpatrick is super passionate about it, as many of us are,
Yeah.
exposing that kind of nonsense that is misleading the public. And my wife was at a conference last fall, in like a coaching conference, and she was to dinner with a group of them. And it was like a multi-millionaire guy, and he's like, "Yeah, I just invested in this thing called an IUL. Like, I really have no idea what it does. Like, this guy just pitched it to me. I dumped like, hundreds of thousands into it. He's like, I'll probably end up losing my money, but whatever." And it was just like my wife texted me.
Wow.
She's like, "You will have you. I can't even wrap my mind around what I just heard out of this guy that's super successful, and he did like zero due diligence. He just took a salesman's word for it."
Yeah.
And that is where it
That's wild.
becomes so dangerous out there. I mean, I get fired up against the IUL guys that misrepresent stuff. I get fired up around Dave Ramsey, as I know you do too, Matt,
Hmm.
that there's just so many half truths that for whatever reason, these gurus, we put them on a pedestal thinking they're fully knowledgeable about all things finance. And so when they speak, I don't have to do any second guessing. I don't have to do any due diligence on Dave Ramsey because he has the best version of the truth. And unfortunately, that's the farthest thing from the real
Right.
truth. And I love that we're here to share some light on that. So what are some of the things that you
Yeah.
see, maybe on both sides of the camp that are just so off base out there on the marketing world, maybe against whole life or pro IUL or pro
Yeah.
anything else that just isn't giving people a streamlined, straight answer on the truth that can get them, off into jeopardy with their finances.
Yeah. There's a lot of, it's the Wild West right now. There's a lot of crazy stuff out there. And that's why I think it's, important for, people like us and everybody else in the agency and stuff with what we're doing with our channels to present the actual facts. Because here's the thing is these things aren't necessarily, I'm sorry, I should put it this way. The decision to go with something like an IUL, whole life, buy term invest the difference, whatever. It's not necessarily complicated. You just have to have all the facts, and then you have to weigh those facts based on what you're trying to accomplish. The problem is that there's so much information. Like there's not enough people trying to share both sides. There's so much information. Like in our business right now, if we're talking about IUL, there's so many more people selling IUL probably not knowing what they're actually selling just based off of what they say than people that are selling whole life, right? And then, you get the Dave Ramsey types that, they're so biased against something or for something that everything else is bad. You should never put your money into a whole life insurance policy. That's what Dave Ramsey would say. Excuse me? I'm dumping a bunch of money into my second policy right now. Like, and there's a specific reason for that. It's because I understand how the product works. And I try to give people the benefit of the doubt, like, because we're not going to know everything, and sometimes we make mistakes, and that's fine. I'm not saying it's bad to be human and to make mistakes, but here's the problem with this particular industry and why it's really hard for me to give people the benefit of the doubt. Because if you are going to sell something to somebody that has life-changing like potentially life-changing consequences, you're messing with people's money. You have a moral duty and obligation to know exactly what you are selling. Maybe not all of the intricate details of like running an illustration. And like, I'm not talking about the technical stuff. I'm talking about how these things actually work. So when, like you were mentioning on TikTok, which is just a cesspool of really interesting stuff when it comes to IULs and infinite banking and tax-free retirement income. Like, I think I saw one of those videos the other day. I got to get more active on TikTok, but he was talking about taking 10%, like screw the 4% rule for your portfolio in retirement. You can take 10%. Excuse me? Really? So like you're just this financial genius that has found this magic unicorn product that is able to do this without any risk. Like, and that's really the frustrating part about that stuff for me too, is they talk about all these amazing things on the surface, but they never talk about the things that can go wrong. And even if you can manage those things, right, that's okay. But if people don't know that exists, well, then you get guys like you just said that drop $1 million into this thing without really knowing how it works, just because it sounds great and it looks good on an illustration. I'm like, dude, are you kidding me? It's absolutely ridiculous. And I was watching a YouTube video the other day where I heard an IUL agent say that he said it twice in the video that you can't lose money in an IUL.
Mm-hmm.
One, I don't even know how that's legal. Like, how are you like from the law and compliance with the company, number
Right.
one. And number two, do you really believe that? I mean, have you done so little research into this product that you don't think you can lose money? Now, I again, trying to give him the benefit of the doubt, I assume when he says it, that like he's talking about you can't lose money in the market. And I think he's assuming that people understand it that way. But if you've never heard of an IUL before, and now you're watching this video with someone saying you can't lose money in this product, upside potential, downside protection, you can withdraw 10% every single year without risk. Oh my God, man. That's the kind of stuff that gets me fired up. And, like I've actually had some productive conversations with IUL agents, not very many, but they've been there, where this gentleman shared a post on LinkedIn. I think it was last week that I saw it. And he posted, and I love this. I love the transparency. He actually posted the results of his IUL that he started 13 years ago. And I really appreciated that. It was underperforming as illustrated, but that's fine. But the back and forth, the little bit of back and forth that we had, like it was a productive conversation. He was answering my questions. I was addressing a couple of things that I thought were a little bit concerning, but nobody got like heated or anything. It was just a good conversation. And that's what I want more of. And I've got an open door policy on my channel. Any IUL agent wants to get on my channel and let's have a productive conversation about this thing. I'm all ears, man. We'll set it up. A lot of people don't want to do that though. You know how many people I've challenged to do that? And like, I had one guy the other day, he said, like, obviously you have no idea what you're talking about with IUL. So why would I want to get on your channel? That's exactly why you should get on my channel. Come educate me. What am I missing here? But I think deep down, a lot of people know that something is not right with this product. At least the way I'm presenting it, that's my biggest issue, is how these things are illustrated, presented, and sold to people. It's not necessarily the product itself, even though I think it's fundamentally flawed and pointless, because you can get upside potential, downside protection in a whole life product without all the issues of IUL. But that's me. People just don't know what they're buying. They don't know what they're selling. They don't know what they're buying. And people are getting hurt. And people will get hurt, when they're 70, 80 years old and they need that. They've been relying on it. They've made major decisions around what you sold them. And now it's a complete disaster. It's blowing up in their face. Maybe it doesn't lapse, but maybe they have half the cash value because it didn't perform the way that it illustrated. So, that's the most frustrating stuff for me, and why, I'm really, I do get a little fired up about it. And it's because you're going to hurt people with this stuff. Whole life doesn't hurt anybody. It can't lapse because of the rising cost of insurance. They're not going to get a letter in the mail at 72 years old saying you have to dump another $2,000, $5,000, $10,000, whatever it is, to keep the policy in force. That's not going to happen with a whole life, even if you don't set it up properly. That 100% base policy, that I would agree with Dave on this, that that's not a good place to put money. It's not very efficient, but when you set it up properly, it's awesome. But even with that terrible design, it's not going to lapse as long as someone makes the premium payments. That's not the case with an IUL. If you don't set it up properly, they can make the premium payments till the day they die, and it's probably still going to lapse. That's the most frustrating part, is the lack of transparency, the lack of disclosure about how these things actually work, so people know what they're putting their money into. Because if you don't, you could really get hurt. I mean, I can imagine dropping $1 million into something I don't know about, and then I think it's going to do something, and then it doesn't when I need it the most. Man, that's devastating to people. And, when you're 70, 80 years old, that's really hard to recover from, when you've put so much money into these things. So that's, I'm definitely getting on TikTok. Like I've seen some of the videos you posted in the Discord. It's just absolutely ridiculous. Like this MPI stuff and oh my God. That's probably going to be the next like thing I do on my channel consistently is bringing up this like MPI crap. I'm like, oh my God, man, this guy is just ridiculous. So yeah,
Yeah.
it's an interesting industry, man, for sure.
Yep. So I think, one thing that I've heard a little bit about, let's dig into this a little bit, and I'll share out a few ideas and things I've learned. And you can fill in anything I missed. So like one of the things that doesn't get talked about on the whole life side is like, what are the dangers of a whole life? Like, okay, if I don't pay my premium, obviously any cash value I built up, is gone, basically. The policy lapses. Um, if I'm taking policy loans and I'm not paying the interest every year, the simple interest at the end of every policy year, it gets rolled into the interest charges get rolled into the cash value and get deducted from it. And if you do that too many years in a row, you're basically compounding against you. And you do that for 10 or 20 years, you
Right.
could essentially compound yourself into a lapse, right? Um, Other than that, am I missing anything on the whole life? Like, what are the dangers of
No.
a whole life? I mean,
So,
it's relatively safe, right?
yeah.
Yeah.
Here's how I describe it, like especially when I'm comparing IUL with whole life and like design and stuff. You could properly structure, you could get like the perfect design on an IUL, do everything right, and it still has a chance of not working out.
Mhm.
Maybe not lapsing, but definitely not what's on the illustration. Even though you did everything right, you could do absolutely everything wrong with a whole life setting it up, and it will still be okay in the long run
Mhm.
because it's guaranteed to grow every single year. Now, as far as risk goes, like the other thing I say is you have to be pretty irresponsible with a whole life policy to make it lapse. Like you kind of have to make it lapse. It will not lapse on its own.
Right.
You kind of have to be the dummy that makes it lapse. Even if you stop making premium payments, assuming that you've funded it properly and you have sufficient cash value to where it can fund itself, you get dividends, the guaranteed growth rate as well, et cetera. It will fund itself. It's not going to do what you illustrated if you stop making premium payments, but that's where design comes in, making sure you set it up based on your current financial situation and what you anticipate in the future. And another thing that's not talked about too much with whole life is that it's flexible. So if there is a year, because we're doing base and paid up additions, you don't have to make your paid up additions payment
Mhm.
that year. You could do catch up payments later. But like for me, the only real risk that I see, and if anybody's watching this and there's other risks that we're not bringing up, I'd love to hear those things. All right, but for
Totally.
me, the only risk that I see is over leveraging the policy, especially
Mhm.
too soon. So if you haven't, well, even if you funded it properly, if you start taking policy loans too early, like the policy has not matured enough, and you're not paying back those policy loans, like you said earlier, the interest is going to roll over, it's going to compound against you. Eventually that can get away from you, especially if you're consistently making policy loans and you're not paying it back. That's where you can get into a lot of trouble with whole life. But for me, that's something that is very easily managed. It's easily explained. Just don't over leverage the policy. That's it. Don't take out 10% every single year like some of these other people will tell you. Be responsible with it. But other than that, I don't know. I don't see where any other risk is with whole life because it's a guaranteed product. And that's the problem with IUL. There's no guarantees, and any guarantees that are in it are completely worthless because it just shows the policy lapsing anyways, at least on the illustrations that I've seen.
Yep.
I make this is a joke, but it's just fun for me. The only guarantee that an IUL has is that it's probably going to lapse.
Right.
That it's guaranteed, almost guaranteed to lapse if you don't fund it properly. That's
Yep.
the only guarantee, though. So there's just too many things that can go wrong. Too many with an IUL. Too many different things that can be changed. Too many different levers that could be pulled. I'm just not interested, man. I'm not willing to roll the dice with my hard-earned money for a couple of extra potential percentage points in growth. Like I see some IUL agents talking about 5 to 7%, or they're illustrating at 6% or whatever. It's like, okay, well, if that happens, why am I taking the risk with this fundamentally flawed product with so many things that can go wrong for an extra 1 or 2 percentage points when I'm going to net 3, 5, maybe 6%, depending on dividend rates and a whole life policy. And I don't have to worry about all this crap. Not to mention, I can get upside potential, downside protection in the whole life product as well. So what's the point of an IUL? What are we trying to do here? Are we just like addicted to stock market performance? Maybe that's it. That's my speculation, I guess. But Yeah. Other than that, from a risk standpoint, uh, the only time I could really see a whole life policy lapsing and getting into trouble is if you over leverage it. You don't manage your policy loan. That's it. It's the only thing
Yeah.
I could think of.
Yep, totally. We get that question with clients sometimes, and you're like, well, what are the risks here? And it's like, well, as you mentioned, okay, you can drop back to base policy premium. Just make sure you keep the policy in force. You can ditch the overfunding or the cash value payment. If you come into a financial pinch, you can, make it up within the policy year. But, if you go outside the policy year, you kind of lose that ability. But the next year, you still might have a little extra window that you can put more on to keep below the MEC line, that taxation change limitation within whole life, that it goes from, losing the benefits of a life insurance policy more into a traditional investment vehicle. And, most of the policies that we design and write, you're going to have enough liquidity in the policy from cash value. If you need to pay a policy premium from
Hmm.
a policy loan, you got that protection. And then usually by year three, you're starting to become closer and closer to, at least in that third year, what you put in, you can loan back out. So you're like a break even in year three, just that year. But then all the years you're at a full break even, a lot of times by year seven, roughly,
Hmm.
with the more recent changes since 2021, I think it was, when the IRS changed some laws with the 7702. But
Hmm.
I mean, at that point, like you're always making money. You're always getting further and further away from the risks that are associated with a policy lapsing if something happens in your life. Like, we want to make sure
Right.
that we understand, as agents, stuff happens for people. People lose their job. People have health issues. People have divorces. People have, just unfortunate things happen. So the whole life by nature, like you said, there's so many flexibilities built into it that protects the client from the inevitable. Things are going to
Right.
happen, so that's I think from our standpoint as agents, we have the responsibility. You mentioned, if somebody's being irresponsible with policy loans, where they're going to put themselves in jeopardy of compounding against it. Like, that's our job as agents, to vet that out and sense that, what, this client needs to get a better handle on money management before I
Right.
sell them anything. I
Absolutely.
need to be there to protect them and get them. I might need to be that tough, loving dad, that presence for them. And, like,
Right.
you need to get your spending under control. You need to get a handle on, why are you spending so much money? Because if you don't get it down on just normal cash flow, if I try to sell you a whole life policy and you're irresponsible with a policy loan, like you are with bad credit,
Right.
I'm setting you up for an inevitable problem that comes
Correct.
back on my integrity. And I can't sleep at night if I sold you something just for the sake of selling you something so I can pad my pocket when it's not right for you. So I think as agents, we have that moral and ethical responsibility, like you mentioned, to make sure we're not putting our clients at risk of themselves, get them
Right.
getting in their own way to self-sabotage something that is great. I mean, our mentor, when we first got into this business, he always said, if you don't get out of your own way, you don't do your own inner work, I can set you up with the perfect wealth program with a whole life policy designed perfectly for you, and you will screw it up in the first couple of years
Yep.
because you haven't gotten out of your own way. You haven't figured out how to manage money, manage your emotions,
Yep.
maybe increase your income, whatever the thing is that people struggle with. That's where you got to make sure that people are in alignment there first. And then you can look at, okay, what's the right product for you? But it's a big thing that just comes down to morals. And I love what we, as inside of the Life One agency, I mean, every agent that I've gotten to talk to and got to know, like you, like, we all talk about integrity first. And about that, we're not talking about, hey man, let's figure out how we can increase our sales, man. Let's
Right.
come up with that PowerPoint slide. I mean, I get in now in my news feed on Facebook, oh, the $1 million closing IUL slide. Really? Like, that's what we're promoting here? Like, how to
Yeah.
close more deals, how to push people into something that they're uninformed about
Yep.
just for the close? Like, are we really that far from integrity anymore? And, I
Sad.
find, because there's probably so many more IUL agents, that I seem to think that is more pervasive with those guys. I mean, on the whole life side, I more than not, I hear guys speaking of integrity, guys speaking about doing the right thing for their client and what we're talking about. And not that I don't want to throw all IUL agents under the bus, because obviously there's some good ones. I know a couple, relatively personally, that they believe fully in overfunded, dividend paying cash value life insurance. They also love IULs. I mean, they do both. And it's an interesting perspective, but they understand the limitations of both and set their client up with what's in alignment with them. And they're not just there to push sales on someone, you know?
Right.
So, so those are a few
Yeah.
of the dangers of, whole life. Is let's compare this. Okay, what are the dangers of an IUL? Because we've spent a little time ripping on it. Let's like get into the nitty gritty of like what are some of these moving levers. I mean, I'll throw out a few and you can add a few. Like, we've mentioned a few already. Like, okay, it's annual renewable term. So we know that every single year you have that IUL policy, the cost of insurance is going to go up because you're closer to your mortality. So the life insurance company is going to charge you more because you've got a condensed amount of time left before they're going to have to pay a death benefit. So it's going to increase that. Your cost of insurance are going to go up. You've got the moving levers of what's the market going to do? If it's tied to the performance of an index through buying options, well, what happens if I have a couple down years?
Right.
And like you spoke to, okay, I hear it all the time too. You can't lose money in IUL. Well, that's a half truth. Is you said that you can't lose money in the market, but the overall structure you can lose money in depending on a few factors. So if you have a lot of policy loans and you have a down year or two, the cost of insurance continues to go up, and that can self-sabotage the policy. It can make it
Right.
lapse or get closer to that point, put it in danger. Um, so there's a couple things right off the bat. What do you want to add to that as far as some of the
Yeah.
dangers of IUL?
No, I can go long time. Dangers on IUL. I do want to just add to something that you mentioned earlier. Like there were so many good points that you brought up, but like the sales part of it, right? Like I'm a terrible salesperson. I don't sell anything.
Right.
I had somebody leave a comment on my on one of my videos earlier. It's like he was poking fun at me for promoting whole life. He's like, tell me you sell whole life without telling me you sell whole life or something stupid. It's like,
Right.
but I don't sell anything. I educate. That's it.
Yep.
Because I know if I just educate the right type of person that this is right for, it's going to make sense and they're going to want to do it. I don't need to push anybody. I don't need a fancy presentation. I don't need any sales techniques. It's just, here's this amazing product. Here's how it works. Here's how I'm using it in my life. Is it a good fit for you? Yes or no? That is it. No, we don't need to sell anything. And if you have to sell something, go sell something else that is not going to have such a massive impact on somebody's life, especially when you're selling it, you don't even know what you're actually selling. You don't know what these things can do to people and how they can blow up in their face. Like you said, come from a place of actual integrity, wanting to help people. It's one thing to say it, one thing to say I have integrity, show it. Show it in your actions. What are you doing? Are you like, instead of just focusing on how many sales you can make, focus on educating people, educate yourself first. Okay. That's number one. And then number two, focus on educating everybody else, your audience. And then it's just natural. They're naturally going to come to you. But yeah, but I thought those were great points. And, like if we're talking about the dangers of IUL, here's the thing, like in comparing it to whole life, with a whole life policy, we're transferring risk to the life insurance company. It is their job to manage that money in a very conservative way. That's what they do in their general funds, lots of treasury bills and corporate bonds and all that stuff, right? You're not going to find a better risk management company on planet Earth, not even a bank. I think banks are terrible at managing risk, personally. How many of those have failed over the last 100 years versus mutually owned life insurance companies that have never missed a dividend payment, right? So with a whole life policy, you're transferring risk to the life insurance company. With an IUL, they're transferring the risk back to you. You're relying on the performance of some kind of index. Maybe it's the S&P. Maybe it's one of those volatility indexes they just made 3 months ago that pulled 30 years of historical data. Oh, if you were in this thing the whole time, you would have made 12% this year, 15% this year. Give me a break. Are you kidding me? And so with all the things that can go, all the different things that can be changed, participation rates, cap rates, even if they go up sometimes, are there additional costs that are being added to make up for that? Do you even know what's happening with that? Do you even know how to read an in-force illustration to show the cost, the changes in cost? Like this thing is not nearly as simple as it's made out to be by these agents. Like it's a really complicated product, a lot of different things that can be pulled. And like you mentioned, probably the biggest issue with it is it's built on a terrible foundation of annual renewable term. And when I hear agents say that your cost of insurance goes down the older you get, or your cost of insurance gets cheaper as you get older, I've heard people say that. It's a half truth. And if you don't know what to look for, if you don't break that down, then that sounds great, right? The truth is, though, your cost of insurance goes up every single year because it's annual renewable term. That's what it does. The older you get, the more expensive it is for for the life insurance to cover you for your death benefit. What they're usually talking about is net amount at risk. Your net amount at risk can go down if the policy is set up correctly, if it's managed correctly. This is not a set it and forget it product. You need to do an annual review, do this every single year to make sure you're on track and to make adjustments if you need to. Because if you don't, that net amount at risk can really get away from you. And that is what the cost of insurance is applied to, is the net amount at risk. So for example, if I have $1 million death benefit and I have $500,000 in cash value, my net amount at risk for the life insurance company is $500,000. That is what the cost of insurance is going to be applied to, not the $1 million in death benefit. It's the net amount at risk. So when you hear agents say it gets cheaper as you get older, they're talking about net amount at risk, but that has to be managed. That doesn't just happen automatically. Your actual cost of insurance goes up every single year. And I did an interview with Elon Moaz the other day. He wrote the book Lapsed. If you're considering an IUL, read that book first, please, and then make a decision. And if you're an agent selling IUL, read that book and see if you want to keep selling it. But he calls things like IUL a completely irrational product. And he's so right, because when you understand how the mechanics of these products work, it just doesn't make sense. Like any rational person with the facts in an understanding of how these things work just wouldn't do it. It doesn't make sense. And I think one of the bigger issues with IUL is how it's sold, how it's illustrated, because the illustrations, that's probably the biggest red flag for an IUL for me. Because you can manage net amount at risk, cost of insurance, you can manage that. I still wouldn't recommend it, but you can. Okay. But the other issue is, okay, so maybe we've resolved the problem of the policy lapsing. What about the policy performance? Because IUL agents love to show 8 to 10% income every single year. You're gonna have $1 million in cash value. You're gonna take out $100,000 a year in tax-free retirement income for the rest of your life, starting at 65. What? Really? Like we're not gonna break that down a little bit. We're just gonna take their word for it. That's ridiculous. The biggest problem with an IUL illustration, in my opinion, is it shows uninterrupted compound growth every single year using whatever average they choose that day. I think it's like right around 7% right now, on a product that is based on stock market performance and the call of options. Right. Explain that to me. So when was the last time the stock market went up every single year? Never. I don't care what the average rate of return is. If you don't know the difference between average rate of return and actual rate of return, you got no business buying an IUL. If you don't understand how call options work, you have no business buying an IUL, right? If you don't know how to manage something like this, stay away from it, okay? But like, all these things that we just discussed, like it kind of makes my brain hurt a little bit. But like nobody talks about it. It's all the good stuff on the surface. It's like the analogy I gave on the panel the other day. Imagine your dream house sitting on top of the hill. Great view of the sunset every evening. Looks great on the surface, right? But what if I told you when you're 70, 80 years old, it's probably going to collapse because the foundation is awful? That's what an IUL is. Can it work? Maybe. But why are we rolling the dice on something that has a terrible, terrible foundation? Just doesn't make sense logically, but you have to understand how they work in order to come to that conclusion. And I take my lucky stars every day that I did, because I want nothing to do with it, man.
Yep, I hear you. Yeah, so a couple of things that what you talked about, I want to talk about a little further is I've watched some stuff with Bobby Samuelson recently. And Bobby Samuelson, if you don't know who he is, if you're an agent and you don't know who he is, you need to know who he is. He is, I think back to my daughter, she's 5, she loves the movie Frozen. And I'm, partway through that movie, where they need help from that like sage master, that rock that turns into the little guy, right? Bobby Samuelson's like that guy in insurance, right? I mean, and he's not just like pro whole life. I mean, he's about,
I'm sure he would love that comparison too.
Right. So every time I watch Frozen, I'm gonna think Bobby Samuelson, but
yeah,
he's not like so blinded by, it's all whole life. Like he is very neutral. He tells what's wrong about IULs. He talks about what's wrong with whole life. He talks about where marketing gets off with both products. He talks about it with annuities. Like he's just there to educate the public and educate agents more specifically. And he says that if you're an IUL agent and you're selling a client and getting them to buy off of the illustration and not, so if I'm getting it right here, the page where it talks about all of the charges, the policy charges. He's like, if you don't ever explain the charges internally within that IUL to your client and you never disclose that and they don't understand that page,
Right.
like you're totally missing the point. Like you can't just sell on this fantasy index fund that, like you said, they just put together last week that they cherry picked a bunch of stuff and call it a proprietary index and look at how great it's going to do. Totally agree with you on those points because one of my biggest pet peeves, I used to be in a BNI, a Business Networking International. And this was before I knew anything about finance and got into the whole life space and infinite banking. And I can remember that Edward Jones guy getting up many weeks talking about, this particular fund or this particular product and it averages whatever that percentage is. And I always back then, I'm like, but the math doesn't play out that way. You can't show me on a piece of paper if I'm sitting down with you and pitching a product, whether it's a 401k or a mutual fund or an index fund, you can't show me a graph that doesn't have at least one negative year.
Right.
If it's tied to the
so
market.
Misleading. It's
like
so misleading.
That to me is day one of ethics. If you're in finance, if you're showing a client a product that's tied in any form or fashion to the market, and you're not illustrating in that presentation a down year, or at least, I think what 30% of the time the market is down any given year.
Yep.
So, okay, if you're going to present something to a client and it's tied to the market, you better be showing 30% of the time it goes down.
Right.
Like, let's show reality here. Let's stop showing fantasy that's not what's going to happen.
But then you won't sell it though. Then they won't buy it.
Exactly. So if you show that, you're going to get lower sales. And so that's just one of my biggest pet peeves. It was a pet peeve before I even got into the industry of just like, wait a minute, this doesn't add up. You can't convince people that they're going to get 6% every single year. And this is the total number. I saw a Facebook post by Dave Ramsey earlier. It's the one that he circulates through. If you invest $100 a month from whatever age to whatever age, you'll have 1.176 million. That's what he says. And I always reply to that, Dave, how many negative years are calculated into this number? Yeah, because you can't do that to people. It's just so misleading and so off base. So that's one of the big gripes I have. The other comment that I wanted to share, dig into a little bit too, is the net amount of risk that you talked about. And I talked about this on the panel the other day, the book, The Financial Pocket Knife. It's a book written all about IULs. And in that book, I gotta get that one. I've listened to it through twice, and there's a lot of the good points about the pros of IUL, but they gloss over the negative aspects. They make it sound like no big deal. And with the net amount at risk, one of the ways that these guys will kind of cover their tracks and say, well, we can manage the net amount at risk is we can lower your death benefit. And so lowering your death benefit from like the million you talked about, if there's the $500,000 of cash value and $1 million of death benefit, let's just lower if the markets are performing well and there's a negative year in the markets and you got a 0%, but your cost of insurance is actually losing you some money internally in the policy. Let's just lower the death benefit down to lower that net amount at risk and see you're good. You don't have to worry about it. We can manage that. It's no big deal. And I look at that going, that goes back to the foundational, like the principles and what you're doing and why you're doing it with your money. We use whole life as not just an investment alternative, because we don't do that. We're not trying to grow a bunch of money inside of it. Can it happen? Can it do it very predictably? Absolutely. Sure. We're not trying to compare it to an investment. We want it to be a storage place for capital so that you can do other things with it. Right. And while you've got it stored there, it's getting good growth. That's great. But if you're going to try to take it over here and say it's going to be compared to investment, that's off base. And so I kind of losing my train of thought here, but the whole idea inside of a policy is it's not for investments, it's for the savings piece of it. And if I'm saying that the death benefit, I'm totally losing my train of thought.
No, you were talking about managing the net amount of risk by lowering the death benefit in an IUL, and then that solves all your problems. We're good, and they gloss over everything.
Yeah, gosh, totally lost my train of thought there.
So yeah, there's a lot of things to talk about with this, so it happens to me too. I get it.
Yep. So
Uh,
let me try to get back on track. So I mean, I was talking about the whole life. What they're saying about whole life is that it totally blanked on me, man. I
mm,
hate when I do this. It doesn't
okay.
happen very, very often to me. I totally blanked on it,
I'll
but
no, all
glad
good.
I got caught up.
I'll address a couple points that
Yeah.
you made. Maybe it'll come back.
Yeah. Sure.
No, so you made some really good points there. First off, if you're lowering the net amount of risk, I'm sorry, the death benefit to manage your net amount of risk,
Yep.
that means your policy is not performing, as illustrated. So yeah, okay. Again, it goes back to what I said earlier. Can we manage, can we prevent the policy from lapsing? Can we pull a couple of tricks here on the policy to keep it from lapsing? Sure. But what about all that tax-free retirement income you promised? Because if you have to consistently lower the death benefit every single time, that's more and more tax-free retirement income that they're not able to take. That
Mhm.
means the policy is not performing as illustrated. That's still a massive problem. Okay, so it's not just about the policy lapsing. It's about delivering on what you promised. So, that's really, really frustrating stuff. And the other thing that I'll hear too, like a way to keep the policy from lapsing, like with loans, we got wash loans as well. I had an agent the other day. He mentioned it twice in the same comment. He brought it up and he said, "Oh, also, did I mention there's a 0% wash loan feature as well?" Yes, you did. It still doesn't solve the problem
Right.
of the policy not performing as illustrated because the money borrowed with a wash loan is not getting the credit anymore. So
Mhm.
you're going to massively underperform. So, all these little tricks that you think you have, you're trying different band-aids on the same broken leg. Like it's
Right.
just not going to work. And then I want to address what you were talking about with the average rate of return, the Edward Jones guides. I you know it's so bizarre to me because it's commonly used and accepted like this average rate of return in the market, which I've never seen anything consistent with average rate of return with the S&P. Like I've seen some people say 7%, some people say 9%. Dave Ramsey says you can get 12% on average in mutual funds. I don't even know how that's legal, how he gets away with that.
Yep.
But regardless, like Jeff, I have run the numbers on this. Okay. I did a full video on this, running the numbers, showing the difference between average and actual rate of return. It
Mhm.
is massive,
Yep.
massive. I basically I took so I'm 35. I invested in this hypothetical example. I invested $100,000 in 1988, went all the way through to 2023. I had a specific number. It's like I can't remember. It was like $1.8 million or something like that. And then I got the average rate of return. I think it was like almost 11%. I took that number, $100,000, 11% uninterrupted for the same time frame. It was almost twice as much money.
Yep.
It is so misleading. What you see in an illustration, I don't care if it's IUL or any financial instrument, that's showing uninterrupted compound growth every single year in a product that has volatility that can lose value in any given year. It's not going to happen. I promise you, it's not going to happen the way you see it, and you need to prepare for that because there is that's the power of compound growth and why like when people say whole life sucks because you only get 4% or 5%. Okay, and I can get 8% in the market. Okay, well, number one, if you're so confident in that, why not set up the whole life policy, get the 3 to 5% compound tax-free growth, borrow everything out of the policy, put it in the market if you're that confident in it. I
Exactly.
don't think you're going to do that. I've never, leveraging to invest in the market, not a good idea. Why? Because it's so unpredictable. Nobody knows what it's actually going to do. So, and people are making life-changing decisions on this. But with IUL, like that tax-free compound growth that you're seeing is not going to happen. It's going to have a massive difference on the end result, and that's why with a product like Whole Life that gets actual uninterrupted compound growth, you could only get 4%. Okay. But over 40 years, 30, 40 years, that number can get massive
Mhm.
and not to mention, you have to account for the tax liability that you no longer have in that product too. That adds at least 1 or 2 more percentage points to that, depending on your tax bracket
Right.
as well. With that, you might net 5, 6, 7% with that. And you do that over 40 years, I'll take that all day. I'll take a few extra percentage points less, put it in uninterrupted compound growth, be able to use it to build wealth in other ways like I'm doing right now. than to maybe get a couple of extra percentage points with some stupid stock market product. Like, just doesn't make sense to me, right?
Yeah, I
But
agree.
yeah, that's just address a couple of things that you mentioned, and just because like these, what I'm talking about, these are the things that change the way I think about money. Like when I
Mhm.
was going down this rabbit hole, like I had just had so many light bulbs go on, and things just like I started putting the pieces of the puzzle together. Everything just started to click, and that's when I saw whole life for what it was. It's like this is one of the most powerful financial assets in the world that we can have for the right person. You were
Mhm.
mentioning earlier, like somebody that's terrible with their money, probably not. But you got your money under control, you're able to save money, and you want to put it to work. There's just you can't beat it, man. There's nothing else out there, at least that I found. So
Yep, totally,
did
man.
you did you did you pick up your train of thought?
I did, yeah, it
All
came
right,
back. So
very
I
good.
was talking about, the underlying like philosophy and principles that are contrasted between why would you put money into an IUL versus whole life, and about the net amount of risk within a whole life that we can lower death benefit to lower that net amount of risk to keep it going and to keep you
With an
safe,
IUL.
right?
With an
Or
IUL,
into an
right?
IUL, yeah, yeah.
Yeah, IUL.
Like being able to do that, and like that philosophy goes against the principle why we use whole life, because in a whole life we're wanting that death benefit to continually grow while we're alive, because if we're on a growth path, our assets are going to continue to go up. Our income's probably going to continue to go up.
Right.
We want more death benefit to grow with us, right? And that's while we're alive. But then the whole principle of a death benefit, big picture, the generational picture of that is I want my kids to basically inherit a larger amount than I had in my lifetime. There's a multiplication at generational transfer that takes place in a whole life policy. Like I want my kids to go up a financial level after what I did in my lifetime that probably went up another couple financial levels, right? Like
Sure.
that's the principle behind whole life. It's what the Rockefeller families have done for 6 or 7 generations is let's up level through whole life insurance. Let's buy the net worth with generation one so we know what generation two is going to do. That adds certainty and predictability to the whole equation.
Right.
With IUL, if you're intentionally lowering the death benefit just to keep the policy going, you're taking away from future generations, like
Right.
knowingly. What that goes against the whole underlying idea with whole life and about it being a multi-generational asset that does so many powerful things from
Sure.
beginning. It's just providing a death benefit. It can be used as a 529 college plan alternative for your kids. It can serve as working capital in your business all the way through. It
Yep.
can be a supplement as a tax-free income stream in retirement to give you a good guaranteed foundational base in retirement. It can help offset Social Security. If you make too much in Social Security, I had this happen with my parents last year. My mom, come tax time a year ago, she's like, "Son, what can we do? Your dad made too much money last year, and he's gonna have to pay back like 50% of his Social Security." I'm like, "Well, Mom, that discussion needed to happen like 5 years ago, and we
Yep.
needed to have more money in a whole life, and that would have kept the income down, and
Yep.
you'd been good." So there's that benefit, and then the multiple generational aspect of transferring money to the next generation to go up levels. That's the whole framework with whole life, but the framework with IUL gets deduced down. So many of those things can get stripped away. I mean, they
Right.
can still be there in some way if everything goes well and that unicorn experience happens where the market does really, really well and you manage everything, like you said, every year. But why would you want all those moving pieces and the jeopardy of things to blow up in your face? And then you pass along and you could have given your heirs $1 million, but because you had to lower the death benefit to keep your net amount at risk manageable to keep the policy in force, now you're only giving them 600 grand. Like,
Right.
why would you ever do that? That doesn't make sense to me. Like, just as a why you got into whole life, there's these things, and then you strip a lot of that away and you reduce the power and benefit that the next generation can get because you maybe didn't understand everything about the IUL. You didn't know
Right.
that, like, okay, the agent said I can just lower the net amount of risk, but do you really truly understand the ramifications of what that's going to do? Like
Right.
that's a big thing. Now, I just lost my dad a week ago, 8 days ago, he passed away, and my
I'm
dad
sorry to
didn't
hear that.
have life insurance. Yeah, thanks, man. And it was like knowing what I know now, if my family got, even $250,000, which is a relatively small death benefit for the type of policies we talk about, if you've had
Hmm.
it for 10, 20 years, that would have been game changing. If my mom would have been able to have six figures and, some would have went to me as the only child, like that is game changing when you talk
Absolutely.
about multi-generational. We went through it when my grandpa passed away in 2018. He had been a third generation farmer. And we got to see like, okay, there was three generations that went into building this farm. And what was left over? There wasn't any financial education that went into that. There was a house that was falling apart. The land had already been sold off and leased off to another, big farming operation. There was like nothing left after three generations of hard physical labor because
Right.
of a lack of education. Like if they would have had if my great great grandpa would have had a death benefit that got transferred to my great grandpa, and then he had a policy that got transferred to my grandpa, and then to my mom, and then to me, like we could be sitting on like literally tens of millions of dollars just off farming
Yep.
if they would have known what we knew now. Like it is game changing, and you want to take a lot of that power away just to keep an IUL going. Like
Yeah.
that shatters my brain, Matt. Like it's
Yeah.
like,
I
why would you do that? You truly don't understand the bigger picture here and
Sure.
what this means. You're just so focused on it's an IUL. You're focused on the lingo that you get to sell it with. It's upside
Hmm.
potential, downside protection. It's great. You can be millionaire, blah, 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 blah. But what about everything else that gets left out of the discussion? And that's
Right.
where anybody that's watching this, if you're an agent, you need to understand the big picture. And especially if you're a customer, you need to think through all these things. And if you ask your agent some of these moving pieces and they can't adequately understand them and
Yep.
explain them to you, you need to run fast.
100%, man. Very, very well said. No, I agree with everything you said. And also, if time's becoming an issue, just let me know. But like,
Sure.
I'm having a blast here, man.
Yeah.
I could talk about this stuff for hours.
Yeah. Yeah.
Okay, so but you just let me know. But
Sure.
you said so many good things there. I think that the we have gotten so far away from the meaning of what we're doing, like the purpose of these things, and we've gotten so far away from the real value that a death benefit gets. I should say this: a guaranteed death benefit, because you could call IUL or really any universal life policy a permanent policy all you want. It's bullcrap. Any policy that can lapse due to rising cost of insurance, which is what every universal life product can do, it's not permanent. Okay.
Mm.
But that death benefit represents so much power and control. And everybody's goal is different. But here's the thing: I want my death benefit to be as high as I possibly can get it for as long as I live. So number one, when your death benefit's growing in a whole life policy, that means your cash value is growing as well. Okay, that's more liquidity, that's more potential tax-free retirement income you can get as well. Not to mention one thing, another benefit that we get from this is the living benefits of these policies. So I had so my girlfriend's grandmother passed away not too long ago, and they had long term care insurance. Okay,
Mhm.
and I'm not saying not to have long term care insurance, right? But there were a lot of restrictions, man. When it came time to collect on that insurance, it was like pulling teeth. And so I've seen firsthand the impact that like it can have on people's lives when you can no longer perform those daily living activities.
Mhm.
If you get diagnosed with some kind of illness, you can't work anymore. Guys, the living benefits that you get from these policies, like that was also one of the main reasons that I'm setting this policy up. And I'm going to be setting them up for my family as well, is to get that in place so that when the time comes, when, I mean, we all inevitably get sick, we have access to a large portion of that death benefit to cover those expenses. Do you know how big of a game changer that is? How much of a saving grace that is to have access to such a large portion of money that you're in control of? There are no restrictions to it. I mean, you could take the money and go to Tahiti if you wanted to, if that's how you wanted to spend your final days. You have that option, right?
Mhm.
And where I was going with that is because a big selling point of IUL is these living benefits. I saw it the other day. This particular company has the best living benefits in the entire industry, 95% of your death benefit, whatever. Okay, the only reason they say that is because you're probably not going to be able to access to it. Most policies are going to lapse. So, of course, they're going to say you get these amazing living benefits because they know you're probably not going to be able to use them.
Mhm.
Okay? Maybe it's not as sinister as that. But again, if we just start thinking about these things logically, everything they're talking about with IUL, it just doesn't add up. And that's why Elon Musk calls it a very irrational product. And why, like we were saying, Matt, I just don't understand. I don't understand it. When we do this stuff, when you understand it, nobody gets it. Why somebody would purchase something like an IUL. But and then, like you said, passing on that generational wealth. I mean, it's the most efficient vehicle for passing on massive amounts of wealth. It literally allows you to buy a massive net worth. Okay. Like instantly, your net worth skyrockets when you get one of these policies. Okay. Not to mention, also, guys, with the death benefit, with whole life policies, you don't have to pay into it for your entire life. You could set up a 10-pay policy. I've seen policies that are only funded for 4 or 5 years.
Yeah.
And they never make another premium payment ever again. And yet the policy still continues to grow every single year. The cash value grows, the death benefit grows for the rest of your life.
Mm-hmm.
By the time you're 70, 80, 90 years old, when you need that death benefit the most, it is guaranteed to be there. You don't have to worry about cost of insurance. You don't have to worry about net amount at risk. And you will be the one in your family that passes on a massive legacy to the next generation. How do you beat that, man?
I know.
How do you beat that? I can't think, I haven't discovered another financial asset that gives us so much power back into our lives with so much chaos, so many things working against us already. This is the one thing for me in my life that makes me, it just gives me so much control in my life over my finances. And why anybody would want to, roll the dice on this kind of stuff. We're talking about the, finances for the rest of our lives and what we're going to pass on to our kids. And, are we going to be okay if we do get sick? What happens if I get into a car accident, whatever, I can't work anymore, whatever. It solves all those problems with one product. Yeah. Like why you would roll the dice with an IUL just to get a couple of extra percentage points in growth or income. It's just not worth it, man.
Yep, I agree.
Not my
A
book.
couple things you touched on there. I want to expand on my thought that I was saying a few minutes ago about, the death benefit and what it does, because the long-term care part of it, I've witnessed a couple times now through in my own family. I mean, when my grandpa passed away, he was on Medicare. He had to spend down all of his assets and the government paid. I mean, we paid for his care, as a collective, the citizens that pay taxes, we paid for his care, right? Collectively. Yep. And the whole idea that if he had a large death benefit and he could have accessed that early, he could have, and there's a couple facets to this, but I mean, he could have paid for his care out of pocket and not been reliant on the government. I know the government wants us to be reliant upon them so that we're disempowered, but right. I come from the polar opposite. I think we should be empowered financially so that we can pay for our own things. I think we have a responsibility that if we need this, we right. pay for it. I 100%. Shouldn't rely upon the collective to take care of me. I know we have different viewpoints in the world about that, but that's my personal belief on it. But then the other side of that is if I can pay for my own care, I get to choose where I go.
Right.
I get to choose maybe not the cheap shop up at the corner that's going to neglect my care. I get to go to world-class care. I get to find the best place to make sure that my life is as good as it can be based on the circumstances of long-term care, right? That's the power of it. And I've seen this firsthand when my dad, he had his second stroke just before Christmas last year, just 2023. Mm-hmm. And he was doing good. He got transferred to like the second step down of care. Mm-hmm. And man, if we had a whole life policy that could have paid out and we could have chosen where he went, he would still be alive today. I could say that with 100% certainty. The system screwed my dad over.
Yeah.
And it pisses me off because he didn't have stuff set up right and he knew better. Right. It's really a hard pill to swallow. I sat down with my parents several times when my dad was in insurance. He sold Senior Health and he didn't want his son to up one him on what they knew about insurance. Right. And so my dad's view of life insurance was what a lot of it is out there of, I need life insurance to bury me. I need 25 grand death benefit. That's it. That's the only benefit of whole life. That's the only reason you have it is to bury me. And right. It's like, that's like having a Lamborghini and going up to the corner to the little party store and getting a bag of chips. And that's the only driving you do with your Lamborghini. Like, yeah. Why would you take such a powerful instrument of whole life and deduce it down to just burial costs when you can right. make it into a productive, literally a entire life, a whole life financial instrument that can leverage and perpetuate wealth? Like it is,
yeah.
It is the difference between middle class mindset of I want the smallest, I want the cheapest, I want it to do the littlest, just to cover that one base. It's a single focus, right? We're just focused on death benefit. We're just focused on burying me and taking that burden off my family, so I don't have to worry about putting me in the ground.
Right.
When we can zoom out and look at the holistic nature of like, what does this piece, this powerful piece do for all the things we've already laid out in this discussion, all through someone's life that can add to the things we're already doing, like the 529 college part. Okay, what if my kid doesn't align with college?
Right.
What happens if my kid doesn't want to become a lawyer or a doctor or a nurse or the things you need a degree from? What if my kid wants to go be an electrician? What if he wants to be an entrepreneur and build his own business? What if, by the time my 8-year-old's, ready for the living adult world and the job market, what if AI is so far along that he wants to get into something with that? Well, is a
Right.
529 going to cover that? No, but if I've got 100 grand in cash value my whole life policy, it's flexible to be able to fund a business or buy equipment if he wants to get into excavating or whatever the heck it is. Like, there's so many things get amplified by having a whole life as a foundational asset in your life, that everything gets better in your life around that,
Right.
versus so many of these other financial instruments that they deduce, they're singular focus, they can take away from things if they don't go perfectly, like an IUL. I mean, what happens if you have an IUL and you're saving for your kids' college and the markets perform? I mean, at some point here, the clock's ticking. We've been on such a upward trend in the market since what, 2010? I mean,
Yeah.
at some point, other than COVID, where it, dipped back, but then it just kept on going, we're going to have to come across a major correction here for
Sure.
probably a few years. I mean, it's going to have to happen. It's a ticking time bomb. I
Sure.
wouldn't want to have an IUL in the next few years. I mean, if we get 2 or
No.
3 negative years in a row, I mean, that's going to be really ugly. There's going to be a lot of class action lawsuits around,
Oh yeah.
why didn't my $1 million portfolio come through in my IUL? So yeah,
Right.
just a couple of thoughts I wanted to add to that. It's
Yeah,
crazy.
for sure. No, I thought I was going to get 7% every single year. That's what my illustration showed me.
Yep. Yep.
Yeah. But yeah, that was all great stuff, man. You're pulling on my heartstrings a little bit with the story of your dad and stuff. And I'll tell you, man, it's stories like that it's why I get so fired up about this.
Mhm.
It's not me trying to be right. It's not me trying to make sales. I'm not trying to sell anything. I'm educating people, and we're both able to help others out with setting up these policies. Right? There's nothing wrong with that. That's a good thing. All right, but that's what really pisses me off is stories like that. The story that I did a video on the other day about the 72-year-old lady whose policy is about to lapse, and she thought I was going to be there the whole time. And it's a lack of education. Like if the right information was just presented to people on both sides so that people can make the best decision for themselves, they'll make the best decision for themselves, whatever makes sense to them. But like people like Dave Ramsey, it's like I cannot stand Dave Ramsey when he says never buy a whole life and all whole life is bad. I hear him tell people to cancel their whole life policies
I know.
that have built up cash value. They're getting dividends on a regular basis, and he tells them to cancel it because it's a terrible product. And yet he won't say that, like the example you gave with your family is if you happen to get sick and you want options for your care, that whole life policy might actually come in handy.
Mm-hmm.
It will give you dignity during your final years. It'll give you options if you do get sick, if something happens to you. And like when you said that, he'd probably still be alive right now if you had the care of your choice. Man, that seriously breaks my heart, man. It's really sad to me because like something could have been done with that if the right information was just presented to them. And that's why I feel so strongly about what we do, and we're trying to get the message out. I don't care how much heat I get from stupid IUL agents that don't know what they're talking about. I'm not talking about all IUL agents. I have heard good IUL agents before. But I mean, let's be real. The majority of them have no idea what they're talking about. And if we gotta take it in the teeth sometimes, from people in the comments and like people disagreeing with us, I don't care. I think that's actually productive because it allows people who are researching these things to see that back and forth and to be able to compare both sides. But I just feel so strongly about doing this because of scenarios like that, and it's not uncommon. It happens all the time. The system, like you said too, it's not designed to help us. It doesn't give a crap about us. We need to take control of our situation, our lives, our finances, and there's in my opinion, no better product, no better financial asset on planet Earth to do that in so many different ways than a properly structured, max funded, dividend paying whole life insurance policy.
Yep.
You just can't
Yep.
beat it.
Love it.
So,
So as long as we're talking Dave and we're on a roll here, I got something. I just made a few notes so I can keep track of all the thoughts I had. Let's dig into a few of the things that like Dave and some of them talk about. I'm curious what your perspective and what your thoughts are on some of these things. So, Dave talks about, and it's in when we become licensed to sell life insurance, it's in the training. I mean, it's put right in front of us that, and Dave rips on it that, well, in whole life insurance, a dividend is just a return of premium, and he positions it in this negative light.
right.
Like you're just overpaying for something. Like how stupid could you be if you overpaid for something and they just give you your money back at the end of the year?
Right.
He positions it like that. Another one is, well, whole life agents are just in it for the commissions. You get so much commissions. Okay. Yeah. All right. Another one is self-insurance. So I'll share a few thoughts and I want you to chime in on your thoughts on this. To me, the dividend part, you're missing the full picture. Okay, if I'm getting a return of premium and it's considered a dividend and it's a tax-free situation, what are my other options? Like if I had a normal fund that's getting taxed, a qualified plan, and I'm getting a dividend from my stock portfolio that went up, like that's a taxable event. So that decreases my overall return. But in whole life, my dividend is tax-free. And they're just saying it's a return of premium. And the return of premium is not just the money I've paid in. It is some of that, but it's also the profit that the company generated that year. It's a blend of those two. But you're getting it tax-free. And then it goes right into your cash value. And at the end of that policy year, the dividend into the next policy year, it becomes guaranteed. So you just added to your guarantees. You just added to the stability of what you have. It's not a negative thing, So what are your thoughts on that, rip on whole life? And let's go through the other couple too.
Oh, Dave Ramsey. All right. So a couple things on return of premium. This is fun for me. So you want it to be classified by the IRS as a return of premium because that's what gives it its tax advantage. Mm-hmm. You already mentioned that they're not just giving you your money back every year, because if that were the case, your cash value would never grow. Right. So the fact that your cash value can be more than what you've paid into the policy means there's something else going on here, Dave. They're not just giving back premium payments. And if that were only the case, what about when I stop making premium payments? How come I continue to get a dividend? Can you explain that to me? No, you can't. The other thing too that it's really contradictory. Right, when you really start to think about these things, because I heard Dave say in one of his videos, he likes to compare this to Home Depot. Like if you owned Home Depot stock, you at least you get taxed on the dividend because that's a real investment. And I thought to myself, wait a minute, you're saying getting taxed is good? At least I'll get taxed. I don't want to get taxed on anything. Exactly. Okay, but then also think about what a dividend is in a stock. Are you not just getting your money back slowly over time? Like you have to hit a break-even point in order to really get a return on your investment, do you not? So if I buy $100 worth of stock and I get $2 back in a dividend, I haven't made any money yet. They're just giving me my money back. So
very true.
It's the same exact thing, except I get a dozen more benefits with whole life insurance. One of them, not only are they're giving you your money back, they're taxing it as well. They're taxing you to give you your money back. Now, I'm not saying not to invest in dividend stocks. Okay, that's not what I'm saying. It's just I'm trying to point out the ridiculous nature of the argument itself. Yep. It's really, really stupid. And it's not like the life insurance company, their only profit center is whole life. Because another example he gives is like that would be like me owning Home Depot stock, and the only way that they make profit is by the people who own the stock or something like that. Something really stupid. And he assumed that only people who owned Home Depot stock shop at Home Depot. That was his example. It was really stupid. But he doesn't think about like all the other customers, which is the same thing with a life insurance company. There's lots of other products that a life insurance company sells, term insurance, sometimes long-term care insurance, whatever. Yep, right. So there's lots of different profit centers for the life insurance company, not to mention they invest the money in a general fund very conservatively. I mean, we can't even dream of putting together such a perfect conservative portfolio of bonds, mortgages, commercial real estate, treasury bills, whatever. Like we could never do it on our own. Okay. They're doing that for us. So that profit, when they put that money to work, that comes back to us in the form of dividends. It's just called return of premium. And thank God it does. And hopefully it always is, because that's what gives it the tax-free treatment, or tax advantage treatment, I should say, because you can make policy, but that's not what we're talking about. But yeah, that's my 2 cents on it. Dave Ramsey has literally no idea what he's talking about in whole life insurance. I've done tons of videos on it. Check it out on my channel. I encourage you to go through the comments too. It's crazy how much people will defend Dave Ramsey, even when facts are presented to them. It's crazy.
Yeah. Oh man, you brought up so many good points on that. I love that. So one of the other ones is, whole life is just a profit center for the agent, right? They're just crushing it with premium. They're making all this commission off you. That's why you don't want to do whole life. That's what Dave says, right? So I got 2 thoughts on that. I'd love to hear what you have to expand on that. So for me, you read, if you ever read Tony Robbins' book, Money Master the Game, I think it's called.
Yep. Long time ago.
So, yeah. That one, Garrett Gunderson's one of his first books, Killing Sacred Cows, goes over these principles as well.
Yep.
Like if you had a traditional qualified account and you tracked the commission or the commissions that come out of that account from your financial advisor, and it might be 1% or 2% or whatever that little tiny number is, and we think that doesn't affect my long-term growth. Like it might make a little bit of difference in the end, but we think 1%, how could that add up to anything, right?
Right.
But if they've tracked it, you can do the math, you can pull up a compound math calculator and do this math. We're not making it up. We're not lying. If you had an account and you had it normally compounding, like you could say, okay, I've got, I'm putting in $5,000 a year, and you can do the math for 30 years. And then you can do that same math and take out 1% every year or 2% every year. After you go 30 or 40 years, their 1% or 2% fee can add up to over 50% of what you could have had. You could have had $2 million, but you've only got $1 million or maybe 1.1 because of that 1 or 2% fee.
Right.
And it really cuts into what you've got in the end. So I find that very ironic that that's okay. It's okay to steal 40, 50, 60% of a client's overall portfolio when they need it most in retirement because of that little 1% fee. But we're money hungry whole life agents because we collected a bigger premium in the first year, a bigger commission in the first year, and have a small trail for a few years, and then it stops. There's nothing after that.
Yeah.
That's somehow worse than doing that. I just have a really hard time with that because that's not reality. Let's look at everything. Let's look at the whole picture here and compare apples to apples. And my last point on this is the way we write a whole life policy, we're not doing all whole life insurance. We're doing cash value. And anytime we add cash value in, and most of the time we're doing it probably worst a 50-50 split, 50% base, 50% PUA. And a lot of times we go down to 40%. And I know some guys will write even lower than that on the base side, and the PUA is, 60, 70, 80%. Some of these guys write that. Well, anytime we do that, we're only getting paid, if it's 50% base, we just lost half our commission because we don't get paid much on the cash value side. So the guys in the IBC world that are writing a 40% base, 60% cash value policy, we're only getting 40% of the available commission that we had. And we're doing that for the benefit of the client so they have more liquidity in year one and several years throughout before the whole life policy by itself can generate cash value on its own. Like those are two things that, are just like mind-boggling to me that Dave doesn't understand those 2 points. And he should, based on his position. So anything to add to that point?
Oh, yeah.
Good.
It's a really stupid argument. It holds no weight. Oh, they're only doing this for the commission. Okay, so number one, there's nothing wrong with making money. I am not ashamed that I will make a commission if I help set your policy up. How are we setting it up, though? Are we setting it up for max commission to me, or are we setting up for max cash value to you? That's how we set it up. And like Jeff, like you just said, when we do that, when we reduce the base premium, increase the paid up additions, we take a massive pay cut on our commission. But we're okay doing that because we're operating from integrity. We want to actually help people. We want to set these things up correctly. So we're not worried about that. And we could still make a decent amount of money on it. And anybody that doesn't want someone to make money, I don't want to do business with you anyways. I want everybody to make money. Just do it with integrity, okay? In the best interest of your client. The other hypocrisy of this argument is, especially with somebody like Dave. So what exactly do you think happens when Dave tells you to go buy a term life insurance policy from his sponsor, one of his sponsors, what do you think happens? Well, first off, I could tell you he probably makes a pretty decent amount of money on his sponsorships. Number two, somebody's getting paid on that sale. So if you really have a problem with people making commission, then don't ever buy anything ever again.
Right.
Don't ever buy another financial product ever again, because that's how some people make their living. It is what it is. It's okay. But then, like you mentioned, Jeff, too, it's very ironic that people are okay paying that 1% to 2% compound fee. Okay, it's not like if you start with $100,000 and you have a 1% fee, it doesn't just stay $1,000 as the fee every single year. When your account hits $200,000, now you're paying $2,000 in fees. So that adds up on its own. But then when you add up all the fees that you paid over that certain time frame, 30, 40 years, if you were to get a 4% uninterrupted compound growth on that, like you said, Jeff, it adds up to hundreds of thousands, maybe millions of dollars, depending on how much money you're putting into these things. Mm-hmm. And it's like, okay, who's getting the bigger commission? Exactly. It's not me. I'm in the wrong business if that's what I'm going for.
Exactly.
Okay. I need to get into assets under management. I need to charge that 1 or 2% every single year as your account value grows. Like, it's just a stupid argument, you know. In financial services, people make commissions. It's what are we doing to make those commissions? And I could tell you this: if you're considering an IUL, most IULs are not structured properly. They're set up for max commission to the agents and not cash value for the client. All right, so just something to keep in mind. But you know, when you're working with people that know what they're doing, preferably have their own policies too. I'm funding my second policy today, and they're setting these things up correctly for high cash value, lower death benefit. Not all the time, just depends on your situation. They take a massive pay cut. Yep. So I don't know what Dave's talking about. He's just talking smack to promote his narrative, make his narrative sound better, so you believe him. Because stay away from this evil whole life insurance product. Look how terrible it is, even though it's the most powerful financial asset in the world, in my opinion. And go over here and buy term and invest the difference. Yep. Really? Because you're going to make 12% on average in mutual funds. Dude, just stop. Stop.
All right. So you brought up term. That brings me to, buy term and invest the difference, which brings us to the whole self-insured mindset. So I'm going to share my thoughts, and I love what your perspective is on this. So for me, my understanding went back to my very first alternative finance book was Killing Sacred Cows from Garrett Gunderson back in 2012. I think was the first time I'd heard about it.
Great book.
He breaks down in that whole book that there is literally no such thing as self-insured, because the definition of insurance is you're transferring risk to an insurance company, and an insurance company manages risk more efficiently, not dollar for dollar like we do if we're quote unquote self-insured. So if I have a $500,000 house and I want to be considered self-insured, I need to have a $500,000 sitting liquid in a bank account,
right,
to be able to, if my house burns down tomorrow, pay for a new house. That's right. Dollar for dollar. I need $500,000 in an account liquid to pay for a $500,000 house. Right. Is that very efficient? No, because an insurance company can say, all right, maybe your premium on that, $500,000, and I don't know for sure what this would be. Don't argue with me in the comments about this, but let's say it's $5,000 a year for that $500,000 house for house, insurance. Well, that's what, 1 cent on the dollar. That's way more efficient. So if my house burns down tomorrow, I'm only out my $5,000 a year premium, right, and my other $4,000 or $495,000 that I would have to have sitting there can actually be productive,
right,
in something else, whatever that vehicle is, right? So if my house burns down and I have to pay the $500,000, I'm out the $500,000 and I'm out my house. I'm out double. Whereas on the insurance side, I'm only out my $5,000 for the premium, and I get, if you paid into it for 30 years, obviously you've paid more and more, but you've had that protection, you've had that peace of mind, and then the money that you didn't have to have liquid to be self-insured will hopefully be way more ahead
right, than
your insurance premiums, right? So it's about efficiency, and it's about being protected. And if you think that by amassing a large amount in a qualified plan is going to get you self-insured on your death benefit, you don't understand insurance. The agent you've got pitching you that whole philosophy doesn't understand insurance and how to be most efficient with your money. And that's one of the powers of insurance in general. And what we do with whole life is it's the most efficient thing you can do with your dollars so that your dollars go further, so that you can
Right.
continue to grow with wealth and do the things you want to do with money, you know? So
Right.
what are your thoughts on the whole self-insurance thing?
Yeah. So again, when you learn this stuff, it just doesn't make sense. Like
Right.
the concept of self-insured, being self-insured does not make sense. So you're mentioning with your example about the house. So not only did you lose the 500,000, that's gone because you have to replace the house. The house is gone. You have to rebuild it. Okay. You also lost all the interest that you could have earned on the $500,000 if you had just had the insurance. Now, you also mentioned that, okay, so if we're paying $5,000 per year, okay, I get that, over 20 years, that's a lot of money. But here's the thing is if you can you could probably take $495,000, put it in a vehicle to earn enough interest to cover the $5,000 that you're paying every single year. So
Yep.
now you essentially have, I mean, it's not technically free insurance, but your money is working for you that pays for the insurance so that you could keep using your money efficiently. So what is the idea of being self-insured here? Just earn the money to one way to do it, anyways, is to earn enough just to cover the cost of the insurance that you're paying. But I like to bring this conversation back to whole life though, because that's usually the context of the argument
Mhm.
is like, especially with somebody that like Dave, who says you don't need life insurance anymore because you're self-insured, which is stupid. Um, here's again going back to how whole life insurance works. Okay, you don't have to pay into a whole life insurance policy your entire life. You could pay into it for 10 years,
Mhm.
never put another dime in it ever again, and it will continue to grow, and you will have life insurance for the rest of your life. Why on earth would you not do that? I guess
Right.
the pushback would be, well, because whole life is more expensive for the same amount of death benefit, I could by term invest the difference to make more. But can you really? Do people actually make more? Is that reality, or is this just more illustration crap? Fantasy land stuff that we're talking about here, because a lot of people don't do it.
Mhm.
But even if you do, why not do both? Pay up your whole life insurance policy, which that brings me back to another point about IUL. You can never pay up an IUL. I meant to
Mhm.
mention that earlier,
Good
but
point.
there it is. Okay, but you could pay up a whole life insurance policy, have life insurance the rest of your life, have access to the cash value to go build wealth. If you're so confident that you can invest the difference, set up the whole life policy, get 3 to 5% uninterrupted tax-free compound growth for the rest of your life, always have the life insurance death benefit, and then use the cash value to go build wealth. If you're so confident that you can do that, why wouldn't you do it in that scenario? Because that is the most efficient way to do it. So that's my sense on self-insured. It really doesn't make sense to me. I guess for some people, again, if they don't really want that control of their finances and they just want to bury their head in the sand and hope everything works out in the end, and they don't want to do the research, maybe. But for people like us, we want to be the best that we could be. We want to we want to put our money in the most efficient way vehicles possible. It's just it's just a no brainer. And being self-insured, you're not self-insured. You either transfer risk or you retain risk. Which one do you want to do?
Exactly. Yep. Oh gosh, I love it. We could probably keep going all night long and all weekend long, but we probably should wrap it up here. And just an amazing conversation. I mean, we brought up so many good points that I hope people get to thinking and really dig deeper into what are they doing with their money. And we're not
Yep.
here to I think we've laid it out pretty well already. Like, make sure that you are educated about what you're doing. Make sure it's in alignment with your core values and beliefs and your goals and what you want to do with your money. And then find somebody that you trust that's done their due diligence, that knows both sides, that can explain pros and cons. And then, dude, do whatever you want to do if you're in alignment with that. But if you can't check all those boxes that I just laid out,
Right.
make sure you keep digging, find deeper truths, and find somebody that is going to be more in alignment with what you want. So thanks for
100%.
joining me today, Matt. How can somebody that's watching you, if it's on my channel, how can they find you?
Yeah,
If
man.
they love what you're having to say, how can they, reach out and, just learn
Yeah.
more from what you have to share, man?
Yeah, you can connect with me on LinkedIn. My name's on the screen there. And then I have my YouTube channel as well, which Jeff, I would love to have you on at some point. I've really enjoyed this conversation. I think it's been very productive. This is the kind of stuff that people need to hear so they can weigh the pros and cons of each. And yeah, the YouTube channel is Millennial Wealth Creator. So check that out. I'm coming out with tons of videos and just trying to get the word out, trying to get it, again, sharing my journey, things that I've learned, and just trying to help people make the best decisions for themselves. So, but it's been an absolute pleasure, man. I had a lot of fun with this conversation. We could probably go for a couple more hours, but
Yep.
probably wrap it up.
Cool. Sounds good. Well, thanks,
All
Matt.
right, man. Yep. Talk soon.